The stock has been climbing for weeks. Every news outlet is cheering it on. Your friends are all talking about their profits, showing you screenshots of their rapidly growing accounts. You feel the pressure, that intense fear of being left behind. You finally give in. You transfer the funds. You place the buy order at the market price. And then, silence. The upward momentum vanishes. The price just stops. For a day, 2 days, a week, it chops sideways in a narrow, frustrating channel. And then it starts to drift down. Slowly at first, then with increasing speed. You're trapped at the very top, holding an asset that everyone else, it seems, is now desperately trying to sell. That feeling of your stomach dropping as you realize you were the last one to the party is a universal experience for the uninformed. It is not bad luck. It is a process. It is a meticulously engineered transfer of risk from the few to the many. This process has a name: distribution. To understand distribution, you must first abandon the idea that the market is a random, emotional crowd. It is not. It is a game of immense scale, played by highly intelligent, well-capitalized operators. Let's refer to all of these large institutions, hedge funds, and professional syndicates as a single entity, what Richard Wyckoff called the composite operator. This simplifies our thinking. The composite operator acts as one logical mind. Earlier in the cycle, this operator accumulated a massive position in a stock at very low prices, when no one wanted it, when the news was bad, and when fear was rampant. They absorbed all the available shares from panicked sellers. Then they carefully engineered an uptrend, creating positive sentiment, attracting public interest. Now, after a long and profitable run, their objective has changed. Their new goal is not to push the price higher, but to sell their enormous inventory of shares without crashing the price. How does one sell 1 million shares of a stock without causing the price to collapse? You cannot simply press a sell button. The market would see that massive sell order and panic. The price would plummet instantly, destroying the very profits you're trying to secure. The solution is elegant and requires immense patience. The composite operator must sell their shares to someone. They need a crowd of eager, optimistic buyers. Therefore, their first job is to create and maintain an environment of peak optimism. This is the phase where you see the most bullish news articles, the most glowing analyst ratings, and the most dramatic price spikes. The public, driven by the fear of missing out, sees a stock making new highs every day and concludes it must go higher forever. They see strength. The composite operator sees opportunity. They begin to feed their shares into this wave of public buying. They are selling into strength. Imagine a large ship unloading its cargo at a busy port. The crew doesn't just dump all the containers onto the dock at once. That would create chaos and damage the goods. Instead, they unload them methodically, one by one, as smaller trucks and vehicles arrive to carry them away. The small trucks are the retail traders, each buying a small number of shares. The ship is the composite operator, and its cargo is its massive stock position. The port is the market at its price peak. The process is orderly. For every surge of buying from the public, the composite operator provides an equal amount of supply from their inventory. This is why the price stops going up. The powerful upward force of public demand is now being met with an equally powerful downward force of institutional supply. The battle between these two forces creates a sideways trading range, a period of churning and volatility at the top of the market. This sideways price movement is the most deceptive phase for the novice. It doesn't look like a top. There is no sudden crash, at least not initially. The price might even poke its head to a new high for a brief moment, only to fall back down. This is designed to keep hope alive. Every small dip is seen as a buying opportunity by the crowd. They think the trend is just resting before the next major leg up. But if you were to watch the volume, the amount of shares being traded, you would see the story underneath the story. You would see huge spikes in activity on days when the price tries to rally but fails to make progress. Picture a car with its wheels spinning furiously in the mud. There's a lot of effort, a lot of engine noise, a lot of flying mud, but the car is going nowhere. That is the essence of distribution. Massive trading volume with little to no upward price movement is a critical warning sign. It shows that a huge seller is present, absorbing all the buying pressure the public can muster. This is the principle of effort versus result. The buying effort is enormous, but the upward result is non-existent. Supply is overwhelming demand. The first major clue that distribution may be underway is an event called a buying climax. Imagine the end of a long, powerful uptrend. The price suddenly explodes upward on the largest volume you've seen in months. The price bar for that day or week is incredibly long, stretching far higher than any previous bar. There is a state of public frenzy. But then, by the end of the day, the price closes far from its high, perhaps even in the lower half of its daily range. What happened? At the peak of the excitement, when buying was at its most frantic, the Composite Operator unloaded a significant portion of its inventory. The public's demand was finally exhausted, and the flood of institutional supply pushed the price back down. This event often marks the highest point of the trend and the beginning of the sideways distribution range. It's the moment the music in the party reaches its loudest point just before it gets cut off. Following the buying climax, the market enters the trading range. This is the port where the cargo is being unloaded. The top of this range is formed by the high of the buying climax, acting as a ceiling or resistance. The bottom of the range is formed by the low of the natural reaction that follows, acting as a floor or support. For weeks or even months, the price will bounce between this ceiling and floor. The Composite Operator uses this range to its advantage. When the price rallies up toward the ceiling of the range, they sell more of their shares to the hopeful buyers. This renewed supply stops the rally and pushes the price back down. When the price falls to the floor of the range, they may temporarily stop selling, or even buy a small amount, to support the price and prevent a premature breakdown. This creates the illusion of stability and encourages the public to continue buying the dips, not realizing they are simply absorbing the inventory of a much larger and much smarter player. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the Annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Within this distribution range, there are subtle but crucial clues about the true balance of power. Pay close attention to the character of the rallies and the reactions. A rally that occurs on shrinking volume is a major sign of weakness. It tells you that there is a lack of aggressive buying interest. The smart money is not participating in the move up. They are waiting to sell at higher prices. Conversely, a decline that occurs on expanding volume is also a sign of weakness. It shows that sellers are becoming more aggressive, and supply is coming to the market more freely. The tide is turning. The Composite Operator is becoming less concerned about supporting the price and more focused on completing their selling campaign before the inevitable decline begins. One of the most classic and treacherous patterns you will see within a distribution range is the upthrust after distribution, or what some call a bull trap. Imagine the price has been trading in its sideways range for some time. Suddenly it breaks out above the ceiling of the range. Alarm bells go off for traders who were considering a short position. The public sees this as a confirmation that the uptrend is resuming. They pile in, buying the breakout. But the volume on this breakout is often lackluster, or if it's high, the price cannot hold its gains. Within a few price bars, the stock collapses back down into the old trading range. What just happened was a final deceptive maneuver. The composite operator used that brief surge in price to unload the last of their large inventory at the best possible prices to the most enthusiastic buyers. It was a liquidity hunt. They needed a fresh pool of buyers to sell to, and the breakout created them. The subsequent failure and collapse back into the range is one of the most powerful signals that the stock is now in the hands of weak, uninformed owners and is ready to fall. So, how does a prudent trader navigate this treacherous environment? The first and most important rule is to resist the urge to buy after a long, extended, and obvious uptrend, especially when the news is universally positive. The time to buy was months ago during the accumulation phase when things looked uncertain. Buying in a state of euphoria is a recipe for financial damage. Your job is not to chase performance, but to identify points of maximum opportunity and minimum risk. The top of the market is a point of minimum opportunity and maximum risk. The action plan is one of patience and observation. First, you identify the potential setup. You see a mature uptrend followed by a buying climax and the formation of a horizontal trading range. This is your alert. You are now in observation mode. Second, you watch the price action within the range. You look for the signs of weakness we discussed. Rallies on diminishing volume, declines on expanding volume, and failed attempts to break through the resistance ceiling. You are gathering evidence that supply is in control. Third, you wait for the trigger. The trigger is not a prediction or a guess. It is a specific event that confirms your hypothesis. The most reliable trigger is when the price decisively breaks below the support level of the trading range. Wyckoff called this falling through the ice. This is the point of no return. It signals that the composite operator has finished selling and has withdrawn its support from the market. The floor gives way, and the price begins its markdown phase, or downtrend. Let's talk about protecting your capital. If you decide to take a short position after the price has fallen through the ice, your stop loss, the predefined price at which you will exit the trade to limit your loss, should be placed logically. A common placement is just above the support level that was just broken. That level should now act as resistance. If the price manages to rally back above it, your analysis was likely incorrect, and you exit with a small manageable loss. Another, more conservative placement for a stop loss would be above the high of the entire distribution range. This gives the trade more room to fluctuate, but also implies a larger potential loss if you are wrong. The choice depends on your personal risk tolerance, but the principle is the same. You must always know, to the dollar, how much you stand to lose before you ever enter a trade. Without this, you are not trading, you are gambling. We must also consider the alternative scenario. What if what you're observing is not a distribution top, but merely a pause in the uptrend? This is called a reaccumulation phase. The price moves sideways, but the intent of the composite operator is to absorb more shares before pushing the price higher. How can you tell the difference? Again, the character of the price and volume action provides the clues. In a reaccumulation range, the declines, or shakeouts, tend to be sharp but short-lived, and they often occur on shrinking volume, indicating that there is not much supply or selling pressure left in the market. The rallies, on the other hand, tend to be stronger and on expanding volume. The support level of the range holds firm. The key difference is the underlying intent. In distribution, the goal is to sell. In reaccumulation, the goal is to buy. The footprints left by volume and price action will tell you which process is underway, if you know how to read them. The great tragedy for most retail traders is that their emotional state is perfectly inverse to the market cycle. They are most fearful at the bottom during accumulation, precisely when the composite operator is buying and risk is lowest. And they are most greedy and euphoric at the top during distribution, precisely when the composite operator is selling and risk is highest. Your primary task as a developing trader is to detach your decisions from these primal emotions. You must learn to buy when it feels uncomfortable and to sell, or stand aside when it feels exhilarating. This is not natural. It requires training, discipline, and a deep understanding of market mechanics. Let's visualize the entire process one last time. Picture a great mountain. The accumulation phase is the quiet, hidden base of the mountain, formed in the shadows of the valley. The uptrend is the long, steady climb up the mountainside. The distribution phase is the peak. It might look like a flat plateau at the top, a place to rest and enjoy the view. It seems safe, stable, but it is the most dangerous place to be. The air is thin, and the weather can change in an instant. The composite operator has reached the summit and is now carefully guiding the public up to join them, only to sell them their climbing gear and begin their own descent down a safer path on the other side. The fall through the ice is the moment the ground on that plateau crumbles, revealing the steep, treacherous cliff face of the new downtrend. Your job is to recognize you're on a high plateau before the ground gives way, not after you're already in freefall. The market leaves clues. It communicates its intentions through the language of price and volume. Distribution is not an overnight event. It is a campaign that unfolds over time. By learning to recognize its signature, the shift from effortless upward progress to a high-effort, low-result sideways grind, you can protect yourself from buying at the top. More than that, you can begin to align your actions with the large, informed operators rather than being the liquidity they depend on. The market demands patience. It rewards observation. If you continue to study these footprints, the story of the market will become clearer, and your place within it will shift from that of a pawn to that of a thoughtful observer, acting only when the evidence is overwhelmingly in your favor.